Right, I think it's 11:01, so we should get going. This week's guest is James Tom from Aberdeen New Dawn. So he's going to be telling us what's going on in that part of the world. And a couple of bits of news that I just wanted to look at this week. Scottish Mortgage obviously announced their results, so I thought we couldn't really ignore that. And then HydrogenOne has just announced more acquisitions and published a quarterly fact sheet. And we haven't really looked at that since it got going, so I thought we'd just have a catch up on that one. So Scottish Mortgage first. I mean, I think part of the trouble with this, and I'll be thinking about what to say, is that it's so well known already. There's very little to add really. So we know it's the largest trust in the sector. One of the things that I've noticed is the discount is widening, and it's a lot wider than it normally is, and I'm slightly concerned about that. Obviously, it doesn't pay much of a yield, as we know, because it's all about growth, and the ongoing charges are very low, helped by its size. So we know that the performance has been pretty dire over the last kind of 6 months or so, and it's almost the worst performing fund there in the global peer group. The one that's done worse is Blue Planet, which is a tiny little thing that unfortunately decided it was a great idea to embrace all sorts of speculative growth stocks right at the top of the market, and essentially more than halved in value. But nevertheless, Scottish Mortgage has been hit fairly hard, but that still hasn't dented its longer term record, and it still leads the sector over most periods in terms of share price and NAV. So what we've done is taken a lot of the froth out, as you can see there. So over 5 years, the NAV numbers still look pretty good. And for a lot of this time, the fund was trading at a premium or quite a small discount. But as we can see here, just in the last kind of 6 weeks or so, that discount started to widen. And we had that sort of spike in May, and I'm not even sure if that's a mistake by Morningstar or not. But this looks like a real number, that we are seeing the discount steadily drift outwards, and that I'm slightly concerned about. So, obviously, given that the fund has not been shy in issuing stock, and actually until recently wasn't that shy about buying it back again either, I would have expected to see a lot more buyback activity to kind of drag that discount down. But you see that the two lots of buybacks they've done over the last couple of months don't even really register on this chart. They are there, they're just so small they don't really show up. So they've only bought back 200,000 shares since the end of January. So really, since this sell-off really got going, and I'm not slightly puzzled as to why, because as you can see here, when there was demand for the stock, this is kind of peak of the market stuff, they really went for it in terms of growing the fund. So I do think they owe it to shareholders to be doing the reverse. This is what has done the damage in terms of the performance. So this is the top 10 as it was at the interims at the end of September. And this is the change since then, up until this morning. And you can see some really big moves in here. So things like Ginkgo Bioworks down 78% and Delivery Hero down 73%. And of course, the biggest holding, Moderna, down 63%, which is something that was 9.2% of the fund. That was about 2 billion quid's worth of Moderna that they held at the end of September. And that's gone down 63%. Nevertheless, at the end of April, it's still the biggest holding. We'll come to why in a second. So the portfolio, as it looked at the end of April, still relatively concentrated in terms of number of shares, a number of holdings rather, about half and half listed and unlisted. The proportion in unlisted has been rocketing up because obviously, even though they are being revalued on a kind of rolling basis every 3 months, there's a bit of a lag there. And as the fund has listed holdings have dived in value, the proportion invested in private companies has risen, so that's now nudging on 30%, and that's up from 19.4 at the end of September. And really, all of that move, they may have made some investments, but I think most of that move just reflects that the fact that on a valuation basis, these have held up better than the listed stuff has. In terms of where the assets are, UK is still really tiny in here. So what this fund does represent is quite a big bet against sterling. And obviously the underlying businesses are really global. But I think that is worth bearing in mind, especially when sterling has been quite weak. So that should have been working in the fund's favour. A lot of things that are just as opposed to the US with relatively stable assets have actually looked to perform quite well recently because the dollar's been so strong. That doesn't really seem to have helped out Scottish Mortgage. On the Moderna thing, so the reason that it's still number one is that they've been piling more money into it. So at least kind of 300 million, I reckon, since the end of September 21. It might be more than that. It totally depends on what prices they were buying them at. But in terms of value, the value of the Moderna stake is about £250 million higher than it would have been if they hadn't bought any at the end of April. So they must have spent at least 300 million topping that up. And they funded that by selling Amazon and Tesla shares. I don't really have any problem with either of those things. Moderna, though, is still not coming up in glory. There's been in the paper the last couple of days because they had one CFO that worked from July 2020 and walked away with $42 million worth of share options. And then they hired a new one and he only lasted a day. So at the moment, he's still due his $700,000 annual salary. But without totally expensive money, he's under investigation for something around allocation of bonuses or something in his last job. Really not particularly helpful. But I think the reason why the managers like it is because of all the other things that Moderna is doing beyond just its COVID vaccines. So the COVID vaccines are really what drove the share price obviously upwards. But they are a sign of success in vaccinations in all sorts of different areas. So they actually have an HIV vaccine trial underway now in Africa. It's only in a phase 1, so it's only got a few people enrolled in it. But that sort of thing could be really quite big. There's a whole range of other kind of viral conditions that it's trying to target there. Plus things like cystic fibrosis and some cancers as well. So this is the argument that the managers are using, that if these things start to come off, Moderna on a PE basis doesn't look expensive at all now, but it's going to look very cheap. So, well, we'll just have to wait and see. But it does seem to me to be quite a big bet, really, given how big a position it was in September, and to put that much more money into it, it is quite a big bet on one stock. We'll have to see how that works out. So, we've talked about the lack of share buybacks. We've talked about the rise in proportion in private equity. One of the other things that happens when these funds start to dive like this is that gearing can rocket up, especially if you've got fixed long-term gearing. And actually, Scottish Mortgage has got quite a lot of that. So I think the gearing today is about 17.5%. It may be slightly more than that. And that number is a lot higher than it normally is. And they're saying that they're acknowledging that this is borne out the share price volatility. And a lot of this is long term. So here's the list from the results announcement. So 1.63 billion of long-term debt in there with various maturities. So we've got some that mature next year, some 24, 26, but a lot further out than that. So that long-term gearing, I reckon, is about almost 20% of the current NAV. That might be worrying if the share price, if the things start to halve again. I'm not saying it will do, but you might start to worry about it. So the good news is that this interest rates on here are so low and rates are obviously rising that on a mark-to-market basis, the debt adjustment is actually positive. So the banks would almost pay you to say, thanks very much, you can have your money back. So running to the gearing down, it may not be as difficult as it was for some people when last time we had a big sort of fallout in the credit crisis. So even though this looks sort of, it's not dangerous is a very extreme word, it's not that bad. Even though it is starting to look quite high, it's really not a problem. Will Moderna and therefore Scottish Mortgage suffer from increasing number of adverse reactions and deaths reported on USVAs? Don't know is the answer to that. I'd have to go away and have a look at that. That's not something that I've registered. We obviously, I'm not a biotech analyst. We do have one, and I can ask him the question, but I don't know the answer to that at the moment. To answer that one, HydrogenOne, still relatively new. Like most of these funds that were launched with great fanfare, it traded quite a big premium for quite a long time. But literally, again, in the last few weeks, that's gone to a discount. And that's true of things like Seraphim Space as well. Even things like HG Capital have gone to a discount in the last couple of weeks. The NAV has been pretty stable, and there's a good reason for that, as we'll see in a second. So it launched, it raised £107 million, and a large chunk of that came from Ineos, because they are interested in the whole transition to hydrogen and being on the right side of that. And it also managed to raise some more money at the beginning of April, which is not bad going, but obviously helped by the fact that it was still trading a decent premium. So it's topped it up with another 21.5 million shares issued at £1, so same as the IPO price. And that issue was oversubscribed, so all well and good, really. And you'd think then there would sort of latent demand that would have held the share price up, but actually now it's down to 93.7p. The reason they wanted the money is because they had a decent sized pipeline of things they wanted to invest in, kind of near term 45 million quid's worth. In terms of where we are then, this is from the fact sheet at the end of March, and you can see there that about a third of it was in the quality liquidity reserve, and those listed positions were also bought so they would be an investment in the hydrogen space, but actually could be turned into cash as and when it was needed for the unlisted portfolio. Obviously, those listed positions have fallen in value, kind of along with the rest of the market. The unlisted ones haven't done. They're all being held at cost. So this was a session at the end of March. Since then, we've had the fundraise, so 21.5 million in, and it's spent 25 million. This thing called HH2E, doing green hydrogen in Germany, which is a joint venture with Foresight. So that is a developer, and it's got projects that are huge. So I think it's sort of could be spending 500 million, a billion, without too much hassle down the line. It's also bought a 20 million stake in a thing called HydrogenOne, which makes fuel cells and electrolyzers. So it's getting to be fully invested again. So that it has now more or less deployed the original IPO prices, and it's got the extra chunk of money that it raised the other day. If it spends that 45 million, then it will be fully invested. This is what it looks like on a geographic basis. So there's a very strong bias to the EU and the UK, and really not very much in North America at all. Now, I think that's just where the manager's expertise is. And here you can see the sort of the theme of it. This is all various bits of hydrogen, but that surely shows up in the underlying portfolio. So these were the 5 largest holdings at the end of March fact sheet. And those percentages have since been diluted by the placing. So it's still a really concentrated portfolio. HydrogenOne, if you put that in there, would rank number 2. Sunfire is using electrolysis to produce green hydrogen, and it's also got a plant that it's developing to make synthetic fuel. So taking the hydrogen it produces and then mixing that with carbon dioxide, I think, and using heat, waste heat from industrial processes to make synthetic fuel. Obviously, it's quite an expensive way of making fuel, but if they can bring the costs down over time, then it becomes a bit more interesting. Alcogen has got very efficient solid oxide fuel cells, which can be used to generate electricity, and that looks interesting. HyROC making biomethane into hydrogen and solid carbon. I'm less convinced about the usefulness of that, to be honest, and maybe we need to get the managers. I think what we will do is get the managers back on here again and try and explain what the attraction of something like that would be. I would have thought that biomethane is probably more useful than clean hydrogen, but there we go. Bramble Geology is making fuel cells in a very efficient way, based on kind of printed circuit board time to decide. NanoSun is in the distribution side of things. So remember, like JLEN has got this compressed natural gas investment where it's got refueling stations for heavy goods vehicles running on compressed natural gas. So compressed natural gas and LNG are two ways that sounds going to be, it seems to be developing. But hydrogen is another possibility, and if it goes down that route, then NanoSun might be one of the ones providing the kind of refueling. And then the other one, which sounds very kind of speculative to me, but apparently they've got a plane in that they're testing, is Cranfield Aerospace, which is developing hydrogen-powered aircraft. So all of these things, quite massive potential down the line, but it is all potential, and quite a lot of investment needed before they actually start checking off on huge amounts of revenue and profits. And all of these things are currently valued at cost. So you can see that there is a risk that, based on listed equity comparisons, because we know that that's gone down quite a lot, we could see that the NAV of this comes down. Let's get rid of that. So that's enough from me. I'm going to now bring on James, and we're going to talk about Aberdeen New Dawn and what's going on in Asia.